Welcome to ValueVest Daily, where we analyze the best value and momentum investment opportunities. Today, we are diving into a seismic event in the crypto world. It's a story of fortunes made and, well, fortunes absolutely obliterated in the blink of an eye. Understanding how this happens is the key to making sure you're not on the wrong side of the next one. So let's just start with this number. $1 trillion. No, that is not a typo. To give you some perspective, that's bigger than the entire economy of a lot of countries. It's just a staggering amount of value. And just like that, poof, it was gone. During the recent crash in December 2025, over $1 trillion in market cap was just wiped clean off the board. It took months, even years, to build up, and it was torn down in just a few weeks. It left a huge trail of destruction. But you have to ask, where did all that money actually go? Well, here's the human cost. Behind those big abstract numbers, you have almost 500,000 individual traders. Every single one of them had a strategy, a position, a hope, and they all got caught in this massive financial storm. Liquidated. It's a clean word for a brutal process. Their positions were just closed out by force. Their capital? Gone. For a lot of these people, this wasn't just a bad day at the office. It was a complete, total, account-emptying wipeout. So was this all just a case of bad luck? And that right there is the million, or I guess trillion-dollar question for this whole explainer. Was this just some freak market event, like a financial earthquake? Or was it a feature of the system, a mechanism that is actually designed to move money from one group of people to another? Stick with us because we are about to follow the money. Okay, first things first, we need to pop the hood and look at the machine that actually drives these insane crashes. It's not really about Bitcoin itself, but about the super high-octane financial tools built right on top of it. Welcome to the engine room of crypto volatility. And that engine is called perpetual futures, or what traders just call perps. The easiest way to think about them is like this. You're betting on Bitcoin's price, but you never actually own the Bitcoin. And you're using borrowed money, a lot of borrowed money, to make that bet absolutely massive. This is why the market moves so violently. An incredible 80 to 90% of all trading volume is in these supercharged contracts. And this brings us to the liquidation cascade. It's a system that just feeds on itself. See, it all starts with greed and optimism, right? Traders take on huge leverage, sometimes 125 times their own money. But then the price dips, even just a little bit. And bam! The most leveraged traders get automatically wiped out. Their positions are force sold onto the market, which of course pushes the price down even more. That lower price then triggers the next level of liquidations. It's a vicious, accelerating domino effect. So if hundreds of thousands of traders got totally wiped out, someone had to be on the other side of that trade, right? That money didn't just vanish into thin air, it was transferred. So let's see where it went. All right, first up, the losers. The main casualties, no surprise, were the retail traders using that extreme leverage we talked about. We're talking nearly $2 billion just evaporated from their accounts. But it wasn't just them. You also had everyday investors in Bitcoin ETFs who panicked, sold at the bottom, and locked in about $4 billion in losses in a single month. And hey, even some of the big fish, the whales, got caught, proving that too much leverage can sink anybody's boat. And on the flip side, here are the players who were patiently waiting with their buckets to catch all that fallen cash. You had the really savvy short sellers, the whales, who were actively hunting for these liquidation levels. You had major institutions who basically saw the panic as a Black Friday sale, scooping up billions in cheap Bitcoin. And then you have the long-term players, governments and corporations, who use zero leverage. They simply buy when there's fear, adding to their massive strategic reserves. This quote I saw from an observer on X, formerly Twitter, just sums it all up perfectly. This event wasn't the end of Bitcoin. Not at all. For a certain kind of player, it was an incredible opportunity. It was the moment the asset was forcibly transferred from weak, emotional, over-leveraged hands to strong, patient, well-capitalized ones. So you're probably asking, how is this allowed to happen? Why can a market be this volatile and honestly this predatory? Well, it all comes down to the rules of the game, or more accurately, the stunning lack of them. Let's just compare this to the good old stock market for a second. I mean, it is night and day. In the stock market, your leverage is capped. There are circuit breakers that literally halt all trading if things get too crazy, and there are strict rules against manipulation. You get a margin call, which is a warning to add more funds. But in the world of offshore crypto exchanges, It's the Wild West. Leverage is insane, the market never, ever closes, and liquidation is instant and automatic. It really is a casino, but one with no seatbelts and no fire exits. And it's really important to know, this is not the global norm. It's not like the whole world thinks this is a great system. You've got major economies like the UK, Japan, the entire EU, and more who have already put strict limits on exactly this kind of high-risk gambling for regular investors. They see how dangerous these liquidation cascades are, and they've actually taken steps to protect their citizens. So this all leads us to the most important question of all. How do you survive in this environment? What can you actually do to avoid becoming another liquidation statistic? How do you move from the 95% who lose to the 5% who win? Pay close attention, because this slide is basically the whole playbook. On the one hand, you have what 95% of people do. They use insane leverage, they FOMO into pumps, they leave everything on the exchange where it's vulnerable, and they trade based on pure emotion and hype. Winners? They do the complete opposite. They use very little or no leverage, they secure their assets offline, they calmly buy the dips, and they manage their risk with a clear, data-driven plan. So what can you do right now, in the next 24 hours? Here are 5 simple, powerful actions. 1. Get your assets off the exchange and into a secure wallet you control. 2. Seriously, cancel any leveraged position you have open that's greater than 5x. 3. Plan to buy the next dip instead of just reacting to it. 4. Mute the noise. Get out of those distracting Telegram and Discord groups. And 5. Automate your investing with a recurring buy and turn off those price alerts that just trigger your emotions. Doing this moves you from being the prey to being the patient predator. And, of course, we have to put up the legal stuff. This is not financial advice, it's not tax advice. We're doing this for informational and educational purposes only. You should always do your own research and talk to a professional. So, we'll leave you with this one last thought to chew on. The crypto market is a deep, dark ocean. Now that you understand the currents, the predators, and the safe places to hide, the only question you have to ask yourself is, are you going to be the whale, or are you going to be the plankton? Please subscribe, like, and share Value Vest Daily for daily learning opportunities before you put your money to work. And hey, please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities. Thanks so much for watching.